So in today's video, we are going to talk about travel nurses and unlocking different mortgage opportunities and what to look out for when you're shopping for a mortgage as a travel nurse. This is David Zai with the Zai Mortgage team, powered by Nexa Mortgage, the world's largest wholesale mortgage broker. And today we're going to tackle a topic that's been extremely popular on my network, and that is travel nurses and the different types of loans and what to kind of look out for. The first part, we're going to kind of go over the different types of lenders first, okay? Because this is going to be very important for all shoppers of mortgages, but particularly travel nurses, and I'll kind of explain to you why. There are a couple different types of lenders. There's a direct lender, which is a company that lends directly from that lending institution. And then you have correspondent lenders, and then you also have banks, and then mortgage brokers, okay? I'm gonna kind of glaze over this, so if you have any more questions or concerns, you can certainly feel free to reach out and I can tell you about more of these. So first of all, let's talk about the direct lender. The direct lender has one set of underwriting guidelines. Typically, they are a retail organization that is giving you the ability to get a loan directly through them. However, with that one set of underwriting guidelines, you really only have one underwriter that is allowed to review the file. So if they come up with certain income, then we'll have to kind of go with that income. And it's really important because if you are going through as a travel nurse, you're going to have a lot of different pays, right? You have your base pay, you have your per diems, you have your housing allowance, you have your travel pay, all this other stuff. And as a travel nurse, I would think that you would want to use as much of this income as possible to be able to qualify for a loan. Having that direct lender is good sometimes. However, I think the really big downfall is every underwriter is going to calculate income differently. And based on that calculation, it could definitely lead to less qualification or no qualification. So that's the direct lender. The next is the correspondent lender. Correspondents have options. Most correspondents that I've worked for personally may have 8 or 9 different options. And the good thing about that is, yes, you go to one correspondent lender and they shop it for you. However, the downside, I would say, is that you're going to qualify for less. And the reason being is there's going to be more cost for that same interest rate, or you would have a higher interest rate to kind of alleviate the cost. And the reason I say that is because with a correspondent, you're dealing with the loan officer who is dealing with a secondary desk and all the support within their company to be able to shop the loan, middle level management, upper level management, and corporate management. That all has to be paid out. And where does that money come from? That comes from your loan each and every time. The third option is going to be your banks. Banks are good. I used to work for banks. I think where they're good is if you work with a direct bank that is maybe smaller, you may be able to get a portfolio product that other lenders are not willing to consider. But once again, you kind of trap yourself into that one underwriter, one scenario, one review type situation. And that's where the big downfall is. And then finally, we're going to talk about the wholesale mortgage brokers, but I'm going to split this into 2 categories, okay? The wholesale mortgage brokers that are the small mom and pop shops, and then the wholesale mortgage brokers that are the mega mortgage brokers like I'm part of, and why I kind of chose to work for them because of all the different options. Let's start with the small mom and pop broker. Now, they're great. Don't get me wrong. If you're going to choose from any of those options that we've talked about so far, and we're kind of progressively working up to what I feel is the best, I would choose to work with a wholesale mortgage broker. And if you're working with a small wholesale mortgage broker, then you're going to have limited options once again. It's kind of going to be like the correspondent. However, you have multiple underwriting channels that you can go through, and you're going to save money because there's not middle level management, because really the broker owner of that company is the one that's going to be in charge of kind of setting the compensation, and there's no other middle level management that has to be paid out. So on average, based on 2022 HMDA data, the average consumer out there, according to Housing Wire, saves between $8,400 on the same type of loan that you can get anywhere else versus a minority who can save up to $10,400. So that's significant savings when you're talking about closing costs, down payment, all the fees that are associated. And a couple years ago, you had to worry about that appraisal gap. With that being said, wholesale is definitely the way to go. Now, As I mentioned, there's like 8 to 10, maybe 15, maybe 20 different options, right? And that's good. You have one underwriter that gives you their opinion of the income, and they can go 20 different options if they wanted to, right? If they have that many investors. However, the reason I chose to work at Nexa Mortgage, being the world's largest wholesale mortgage broker, is that I have 220 options. I could literally cast your loan out to 220 different underwriters and investors. And the beauty is when you have everyone looking at it, they can say, oh yeah, based on this information, I feel like you could qualify for this much. And we can do this 220 times until we find the most favorable finding. With that being said, it's also about product and then pricing, which is very important, because the more money you save on closing costs, the more you can apply to buying down the interest rate or paying down debt to qualify for a little more. And I know with the travel nurses, it's really, really, really important that we're able to use as many of those per diems and or variable pays as much as possible. So now that's out of the way, we're going to talk about the different types of loans that you can get for travel nurses. First of all, a conventional loan. Conventional loan is going to have a lot of leniency, a lot of different ways that you can structure the loan. So it's definitely beneficial from that standpoint. And what I mean by the structure is, on a conventional loan, you put 20% down, you don't have any private mortgage insurance. And private mortgage insurance is to protect the lender against any defaults, okay? However, if you put less than 20% down, you have options on how to structure your mortgage insurance. You have your monthly, which is what everyone's kind of used to. Every single month, you have a certain fee that kind of goes on there, and that's your mortgage insurance. Then you have your single premium, which is an upfront charge, all upfront, and then you won't have to worry about a monthly mortgage insurance. You have a split premium, which is split half and half. So you can pay a little bit of premium upfront to get a lower mortgage insurance premium. And then you can also have lender paid mortgage insurance premium. The lender would give you a higher interest rate, give you a lender credit for that, and then we would take that money and buy off your mortgage insurance. So you qualify for a little more. The other benefit about mortgage insurance is, if you do have monthly mortgage insurance, that goes on for as long as, let's say, 9, 10, 11 years max, and it's going to fall off. So when it falls off, that's typically an indication of, hey, we have looked at your amortization schedule, which is every single month when you're making your mortgage, you're paying a lot of interest up front and very little principal up front. And then as you go month to month, this starts closing the gap, okay? And towards the end of the loan, interest it goes low, and then the principal goes high. And at 78%, you can cancel your mortgage insurance. Tips on that is, I would say you would want to have at least a 640, 660 credit score before you consider conventional, unless you're a first-time home buyer with low income. And at that point, we can eliminate a lot of loan level pricing adjustments. However, keep this in mind. On conventional loans, if the loan has any change during the loan, and especially for conventional loans, if it gets changed from the automated underwriting to an approved eligible to a refer, which is a manual underwrite, conventional does not allow for manual underwrite. So it's very important that you work hand in hand with your lender to make sure that you know all of your options and that you're well qualified on that conventional loan before going down that path. The second type of loan is an FHA loan. 3.5% down is the minimum. This is a great product because FHA allows us to have higher qualifications on your mortgage based on the debt to income ratio. So conventional tops out at 50% on the front and back end, and that's where it's beneficial, because if you have very limited debt, conventional is the way to go. However, on an FHA loan, they use a front and back ratio, and the front ratio typically can go up to 46.99% of your gross income, and that's just for the housing expense. With the additional debts added in, it can go up to 56.6%, and in certain situations, it could possibly even go higher. As long as the underwriting findings are accepting it, it's fine. And you know how I mentioned that on conventional loans, if it goes manual with the refer eligible, the loan cannot be done. Well, on FHA loans, they do allow for manual underwrites. However, their manual underwriting guidelines are very stringent, so make sure you understand those before you proceed. On the mortgage insurance side, there's an upfront mortgage insurance premium that's charged, and it's actually financed into the loan. And then after it's financed into the loan, at closing, your mortgage payment is going to include more principal, interest, taxes, insurance, and monthly mortgage insurance. And that mortgage insurance, I will tell you, if you don't know this, it goes on forever. So for the life of that loan, until you've refinanced the home or sold it, until it's out of your name, you're going to be paying for that monthly mortgage insurance forever. The third loan program we're going to talk about is VA. That's Veteran Affairs. VA loans are for anyone that is active duty military, reservist or National Guard, a surviving spouse, and you can check all the eligibility for your VA criteria. However, with that is zero money down, okay? That's the minimum, as long as that entitlement is there. And a lot of times you would want to get your member 4 copy of your DD 214 to show your service records. If you were in the reserves, I would get your hours statement, because that's going to tell us whether you qualify for that VA loan or not. With the VA loan, with the mortgage insurance, it's just an upfront funding fee. But here's the good news. There is no monthly funding fee. The funding fee can be waived if you have any disability at all, starting at 10% disability. And some of the benefits are going to be typically a way lower payment because there's not a monthly mortgage insurance. Zero down payment, and very, very competitive interest rates. So with those competitive interest rates, VA has very few loan level pricing adjustments, and that definitely helps out when pricing out a loan. Now, the other benefit of VA loan is, once again, this loan can be manually underwritten, and on the debt to income ratio, it can go way higher. So if we're not able to use some of your per diems or travel allowance and just using your base and maybe your shift differential, then at that point, what we can do is it can go all the way up to a 77, 78% debt to income ratio. And that helps with more buying power. So if you're getting a VA loan as well, the only type of co-signers that you can get is your spouse or another veteran in using split entitlement. I would highly recommend that you go ahead and call the VA Home Loan Center and get your certificate of eligibility before applying for the loan. However, most lenders are going to be able to pull your certificate of eligibility and tell you how much you have left if you've used it one time, or maybe you have another home that you are departing. So if you're transferring from Rhode Island to maybe North Carolina, you would still be able to keep that house in Rhode Island and use the remaining entitlement to buy your house in North Carolina. And if your entitlement is only going to cover, let's say, $300,000, and you want to buy a $400,000 house, you could still buy the $400,000 house, but you have to put down a quarter of the difference, which is $25,000. And a quarter of that difference is the difference between your max qualification of $300,000 and you're trying to buy a $400,000 house. That difference is $100,000, and a quarter of that is $25,000. The obstacles that you're gonna really encounter when going through this process is employment challenges, right? We really need to look at the employment challenges. How many times have you changed your job? Even if you've been travel nursing for the last 10 years, however, you're notoriously changing from one employment opportunity to another. When you have too many changes, a lot of times they're going to pay you differently. So if you're going to have these changes, make sure that you negotiate a guarantee for your per diems, a guarantee for your travel allowance, a guarantee for your housing allowance that's comparable to your most previous employers. And at that time, if we have that continuity, let's just say your salary changed from 50 to 70 to 80 to 100,000 as your base salary, and then your per diem stays the same from each one of those previous employers, and your travel allowance is the same as every one of them. At that point, it's going to make our job a lot easier. We're going to say, okay, we can use the higher pay, and we're going to use the same per diem and same housing allowance and same food allowance, whatever it may be, to qualify you. So when you're doing this this type of loan and you're in this field and you know you want to buy a house, it's really important that we keep that continuity going. And once again, another thing that's continuity is like, hey, are you going travel nurse to different positions, or are you going travel nurse to contract nurse to travel nurse to working in a hospital for a while and then back to travel nursing and wanting to qualify now, with that type of variance, we're really going to just base it off of your base pay. If you're going through this process, I know the pay is also extremely difficult to guarantee sometimes. It's really important that you're saving your pay stubs, okay? Each time you leave a job, you want to have that last pay stub so that we can look at the pay stub and see how everything's kind of broken down. I would also save all of your end of year pay stubs that you get. And that way we can look at the entire year and say, okay, if you've had the job for, let's say, the last 2 years, if you have your year-end pay stub, up front, your loan officer can do better qualification because we're able to look at your pay stubs and say, okay, well, this is how much you made total for the base income for the year. And then this is how much you made total for the per diem pay. This is how much you made total for food allowance or travel allowance, so on and so forth. So that's going to allow us to go through and qualify you better up front versus you applying, providing all the documents to us minus those pay stubs, and then us having to reach out to your previous employers and asking for verifications of employments. And I'll tell you, with the verification of employments, they do kind of like, throw the loan sideways every once in a while, because maybe that HR person that's filling out the verification of employment may only put partial information or not have all the fields filled out on the Fannie Mae verification of employment form. And that's something that's really easy for you to kind of look up. You can just Google verification of employment mortgage form, and you can look in there and see what all the fields are when going through the process. Gathering your documents up front is very, very important too. I would say, to have your income, your asset, and your liabilities documents all up front. If you're using money from retirement, get your terms and conditions of withdrawal. Anything that you're using for that, get it. If you have a trust, we can use that income as well. So make sure you're going over everything with your loan officer. When you choose to work with a loan officer, you're pretty much married, and you got to let them know everything that you have from your income, assets, and liability standpoint. When you're going through the process, it's really important, the do's and don'ts, okay? So don't change jobs, okay? That's very important. When you're going through the process, don't change jobs. Keep your hours consistent. Make sure we don't take any major leaves that are gonna kind of affect it. And typically, a lender is only gonna need that one pay stub, okay? So if you have 8 different pay stubs that are within the last 2 months, I would make sure that you find the pay stub that's going to have less of the variances in income, like time off or bereavement or any of that other type of income. And that way, when we're making a decision on your loan, we can certainly look at it and not question, hey, why is there a drop in hours? Why is there a drop in income or anything else? That's definitely like tip number 1 to go into the process. Don't acquire any new debt, because even though we have all these verifications in place at this time, depending on how that verification of employment is filled out, that could really affect the income. And I see a lot of shifts from upfront when the loan officer takes a look at the income to the underwriting aspect of it, to getting all the verifications back, to the final verification. And we've seen shifts as high as like 8, 10, and even 12% change on income. When you're gathering the docs, you got to make sure as a travel nurse, is very important to make sure that you have all of your income docs, all of your pay stubs, well organized. Same thing with the bank statements. When we're looking at bank statements, we don't want to see a lot of large deposits that are not payroll related, or overdrafts, or maybe even withdrawals going out to the same person a couple times a month or every month in a row. When we see that consecutiveness of the withdrawals or the income coming in, we're going to start questioning it, and that makes your loan a lot harder to do. If you are looking to purchase a house as a travel nurse right now, I would definitely game plan up front. Of all the professions out there, anyone that's commission-based, travel nurse, longshoreman, it's very, very, very important up front that you get everything verified with all of your documents, because that's going to guarantee a smooth closing process. With that being said, my name is David Zai. If you have any questions or concerns on how to get a loan, the type of loan, the different considerations that you have to go through when choosing your housing, feel free to reach out to me and my team. My calendar link is below. If you like the content that I've shared in this video, please subscribe to my channel, hit the notification bell, because there's always content coming out, a bunch of shorts coming out that are constantly going to help you achieve the dream of home ownership. So my name is David Zai. Give me a call at 757-478-8493. I'll talk to you later. Bye.